Hey everybody, it's Jer. I want to do a video today about when you shouldn't put so much weight or emphasis on earnings reports. And those times are whenever you have a company that, or companies that are either a growth company just starting out and just starting out as in like the last couple of years and kind of trying to get the swing of things and they're focused on their growth. You shouldn't expect some kind of great numbers from revenue or earnings. You shouldn't expect it. And I saw this with Meta, which is Facebook. Back when they first started, I saw this with Snapchat. And I didn't see this with Walmart, but I know how Walmart's story was because I've seen the news articles from that time. Each of these three companies had people saying, "You're not making any money. You're not making any money." And, whenever Facebook came live on the stock market, started trading publicly, the naysayers were like, Facebook will not make any money. They're focusing too much on mobile, and mobile doesn't even exist yet, and everything is on the computer still, is still online. They should be still focused there, and they're acquiring these companies and they're spending too much money. They're throwing away money. And at that time, when they went live, I think they went on public at like $36 a share, and then dripped from there to like 20. Whenever they were at like 26, I was like, listen, you should get Facebook stock, because they have a plan, and it might sound outlandish and it might sound crazy, but mobile is growing. It's not there yet, but they're investing in mobile because mobile is growing. The mobile ads is growing. And now you look at Facebook and it's way up there. Let's actually go and look there. If I can find it here. Let me go here. We will go and look on Google Finance. This is Facebook. This is their max. This is when their stock came live. It was like 38.23-ish is what they ended at on May 18, 2012. And then they kind of went down from there because they had some earnings and earnings calls, and so it just stayed there, because people were concerned about the future because Facebook was putting too much emphasis on mobile. And still here, a year later, you see that they were still struggling in that area. And then gradually, once people started saying, "Oh, okay, these investments are starting to pay off," the stock continued to rise from there, going all the way to where it is now, which is $323.57 as of October 29th. You can also see the same kind of thing with Snap. Snap was a little bit different. They started off, let's see here, at 2709, March 3rd, 2017. You can see as they ended at 2709. And then kind of just slipped from there because people were like, "Oh, Snap isn't going to be able to do anything. They can't do this. They can't make it." Also, at the same time, Snap was being offered I believe $1 billion, maybe even more than that, by Facebook to buy out Snap. And they struggled. They struggled a lot, even going all the way over here to where they were under $6. About this time, I was like, this stock is way undervalued. And they were way undervalued. And as you can see, they went up here. Now then, Walmart. Walmart started off way back in the 80s. They didn't start. They started off in the 60s, but they went public in the 80s. There were a lot of naysayers because Kmart was a thing. It was huge. Everybody was like, Walmart's this company from the South. They're just in the South, similar to Waiter. They're just in the South and Midwest. They won't ever make it to anything. And then in the 90s, Walmart started doing a thing called Supercenters, and then they opened Sam's Clubs. And sure enough, we're over here at $149 a share. They weren't ever actually at this 34 cents a share. What ended up happening was they did stock splits throughout the years, which made this look less. I don't know what their exact numbers were whenever they went public, but it wasn't 34 cents a share. Waiters is a little bit of a different story. They went public via SPAC, and you see here their public went crazy to 13.8 or 1386 to close on that day, which was May 15, 2019. I believe they went public though. They actually went public over here with the 12.59, I believe, and I may be wrong on this. $12.59 high, and then as you see, they fell. They fell because of bad money management and struggling. So if you look at this, Waiter isn't the same, obviously, as Snap and Facebook and Walmart. Waiter is more of a turnaround story. And gradually they have turned around, and then they struggled some more. And now I think this is where the real actual turnaround is, where you see now at 194. And I'm saying that, let's see here, go here. I'm saying that you shouldn't put so much emphasis on earnings reports, because Waiter is still doing a turnaround, and they are still, in my opinion, trading. They are trading at a price, a multiple of revenue that already has tremendous bad news baked in. 194 is tremendous bad news already baked in. 1.13 times revenue is saying that the company is only worth what their revenue was for this last year before any earnings, before this next quarter. The last 4 quarters, you're saying that the company is only worth what their revenue was for the last year. That's insane to me. Whenever you look at, let's see here. I did this earnings breakdown yesterday in a video. You can find this on my Twitter. Whenever you look at Dash, and they are trading at 14.76 times revenue. Yes, maybe Waiter shouldn't be trading at 14.76, but if they were, they would be trading at this 25.34. I don't think that they should be. I don't think that they should be trading 14 times 76 times revenue. I don't know that Dash should be trading at 14.76 times revenue, but I do think that Waiter should be trading at closer to like 5 or 6 times revenue, which put them in like around the $9 to $10 range. I think that's reasonable. I don't think any company should be trading, unless they're just like their revenue has no profit whatsoever. Like looking at, and some people said on the last video or have commented that revenue isn't profit. Okay, I get that. But then look at Doordash's profit, which is a loss of 30 cents per share on 300 million shares. This is a quarter. This is per the last quarter. Grubhub, a loss in the last quarter of 56 cents per share on 1.06 billion float. Waiter has a 4-cent loss on $106 million float. The float may be a little bit off, as someone has pointed out. We don't know exact numbers on float because of a pending or a at-the-market offering that has been done. So it may be a little bit off, but this is going off of the last quarter. And I'm going to share this on my Twitter as well. But what I'm saying, and if you're not into Waiter or whatever, that's fine. and this goes for any company, don't always put so much emphasis on an earnings report. Unless that earning report is like, hey, we just threw away $300 million, our revenue was $300 million, then kind of be concerned. But if they are making investments into their future, if they've recently made investments into their future, it takes time for growth. It takes time for a turnaround. So for me, and this is me, maybe you see something different. Maybe you think they aren't going to be able to make it, whatever. Get out. That's your choice. That's your money. You should manage your money, manage your investment. For me, I'm staying in because I see the potential here and I see what they're trading at, what multiple of revenue they're trading at, and they are still way undervalued. And any kind of negative news, unless it's like tremendously negative, like the company just did zero revenue and they're just blowing money on nothing, then I'm staying in because they're trading at a 1.13 multiple of revenue, whereas like these other competitors are trading at, I believe like Grubhub, let me look, I have the number for Grubhub. Grubhub is trading 8 times revenue, and at a loss they're losing 56 cents per share. So like that's just me. I'm staying in Waiter, and this goes for any other company that is a growth or turnaround company. Give it time. Do not base your selling of your investment on a quarterly revenue miss or quarterly earnings miss. Like I wouldn't. But again, that's just me. This is how I look at, like I said, this is how I looked at Walmart. Walmart wasn't around whenever I was born. They were around before then. Excuse me. But this is how I looked at Snap and getting into Snap. And this is how I looked at Facebook and getting into Facebook, was that all the naysayers were saying, oh, they aren't profitable, they're not making enough money, they're making bad decisions because they're investing into mobile advertising. Nobody's going to advertise on mobile. Where it is on the computer, and they should stick to that, and yada yada and whatever. Let naysayers say what they will. I believe in Waiter, and I believe in like companies that are investing into the future, that are maybe missing earnings right now. Maybe they aren't hitting the mark on earnings and revenue and profit, but I see that they are doing what it takes to make a profit in the future. I'm going to invest into them. But that's just my opinion. Do your own research, have your own plan, have your own target price, and you are the person that controls when you push buy and when you push sell. It's up to you. Okay, I love you all, and I will see you very soon. Bye-bye.